What's going on, guys? I want to give you guys a simple little rule, a little heads up, a little tip. So I'm going to get off the 5-minute time frame here on the NQ. By the way, my name is D Anthony with evolutiontraders.com. I do live trading on options as well as futures every single day. I have a couple of courses, run an online community with student traders, this, that, and the other. But what I'm going to go forward and start to look at here is the daily chart, right? So I want to kind of show you guys something here. Now, you're not going to need to really pay attention to everything else that's going on, just a couple of different lines. So first things first is the NQ on the daily time frame is below supply. What does below supply mean? So if we kind of look at it, we're below the 20 and the 50-day moving average. That's your big kind of daily time zones, right? Like, are we trading above or below, some of the bigger moving averages? And typically it's the 50-day moving average from the daily standpoint, right? So anytime we're trading below the daily 50-day moving average and we have a gap up, it's not a time to be excited, right? Like, you don't want to be getting excited because you see the futures or the overnight session, surging higher. We're up 100 points, up 150 points. Because normally when you're under supply, meaning under the 50-day moving average, those gap ups tend to kind of fizzle out and then we tend to reverse. In fact, what you want to see when we're trading below supply is either a flat or a red open to then see a little bit of a washout and then a move to the upside. So if I go to the 5-minute time frame, right, and we look at this 5-minute time frame, and I'm going to go all the way back to the open here. I'm going to give it about 30 minutes into the pre-market data. If you kind of look at where we were trading at on the NASDAQ futures, we were trading above into this gap up, and then quickly within that first opening range, we took out the pre-market levels on the futures, and then we kind of put in this high. Now, in order for us to be able to get long or to think that the market's going to continue higher, we would need to confirm the first hour's highs. Okay, so the first hour is generally going to be within the first 30 minutes of the market. So depending on your platform, if your first hour candle is going to start at 6:30 a.m. Pacific Standard Time, then you're looking at the 30-minute view, so 7 a.m. If you're looking at Thinkorswim or any of these other platforms that go from hour to hour, meaning 6 a.m. to 7 a.m., then it's that 7 a.m. candle, which is going to be after the first 30 minutes. So if we were looking to play long here, we would have needed to ignore this move because we were already on a gap up, and then we were going to need to see the 15,060 area get taken out to the high side, and that's when you would have wanted to get long. But in fact, what we did here is go ahead and go to the downside. So if you look at the high that was put in, we flushed all the way down to the 5-minute 50 SMA. Then we had a little bit of a dead cat bounce, creating a lower high, followed by the next move down, a little bit of a bounce that got rejected at the 20 SMA, followed by a new low into the 200, followed by a continuation bounce into the 20, creating the third lower high, followed by the next downwards move into the linear regression and a rejection at the 10 and 5, lower high, followed by a back test of this linear regression before we finally started to take out a previous lower high. Now, it was on this area you could have taken a little bit of a scalp to the long side, but again, you can kind of see that when we gap up is not really the time where you want to be going long. So again, a lot of newer traders like that we're trading up higher in the pre-market or overnight session on the futures, but when you're under supply, that's not a good thing. Now, if the NASDAQ 100 was trading over the 50-day moving average and we gap up, that's completely fine. What you would want to see in that particular scenario is a continuation through the pre-market highs. Any type of pullback, you're going to want to buy the bounces and then reload on the continuation through the new highs. But when you're trading under supply, again, on the daily time frame, I don't care if you're trading the futures, you're trading options, it doesn't really matter what you're trading. If you start off looking at the daily chart and you notice that we're trading underneath its daily 50-day moving average and you get a gap up higher, you want to avoid buying the gap or going long off the bell, because typically 8-9 times out of 10 that move's going to be very short-lived and then it's going to pull back on you and literally you're going to be sitting at the top of the candle. So in fact, what you want to do is go ahead and let it exhaustion move to the upside, let it put in a high, let it start to trickle down, and then let it start to lose some levels. Again, if you guys, kind of follow my strategy here, using the 20 SMA chart, we did have a little bit of a fake out here that, potentially could have gotten stopped out, but realistically didn't really take out the 1 bar stop. But I understand that this candle is kind of a big stop for some of you guys. So let's just call this first trade a loser, but the second trade here was an absolute winner. And then we came into supply here. And then once we took out the new low into the demand zone, that second trade was a winner. So you would have won 2 trades, you would have lost 1. If you would have traded the first 2 or 3 hours of the market open, and you would have been very, very profitable because the moves to the downside were a lot larger than the potential 1 loss on the stop out. Again, if you guys want help with this and you guys perhaps want to watch my screen when I'm trading with the team live each and every single morning, maybe you guys want to learn a little bit more on how you guys can take a more realistic approach to kind of trading these markets and being on the right side of the market, right side of the trade, and being a little bit more consistent, you guys can definitely join evolutiontraders.com. The new month of October has opened up, so I've got a few more spots. Each and every single month I open up the room to a couple of traders that are looking to learn. Again, evolutiontraders.com. That link's going to be down in the description box below. Take advantage of it because it's definitely a first come first serve basis. I don't just open the room and let hundreds and hundreds of people come in. I only take a few students each and every single month, and as soon as those students kind of come in and we start, getting to work with them, I really start to tone back the announcements on joining the room until the following month. But again, do not buy gap ups when we are below supply. That's the whole idea of this video. What you want to do is let it put in a high, and it really needs to confirm after the first hour before we do go long. If not, we're looking for that rejection and then looking for the loss of low of day, the opening range, or we're looking for those fresh 20 SMA setups to the downside. Again, same thing goes as if we're trading over the 50-day moving average. We really don't want to buy any big gap downs in the market, right? We want to be looking for those plays to the upside. Hope this video helps you guys, and I'll see you guys all on the inside in Evolution Traders.